1/14/2013. Time is 1:50 p.m. Pacific Standard Time. I have a chart up here of how we started 2013 in the S&P on a daily. We are overbought, and let me tell everyone right now that we're going to go lower. And that the wall of resistances, when you can't break through those resistances on heavier volume, that means that this whole narrow range topping pattern from the fiscal cliff, that's the big one-day gain on the S&P, 1420, and we've been right up here at the highs. We're in a major earnings season. The thing about this particular move, everyone, is to be aware. One of the things that I will highlight is the 2/16 February 1375 put. They bought 11,000 of these contracts. Some people were buying 1,000 contracts here at 345, 500 contracts. This is big volume on contract size. And we can see they close at 340. They don't move a lot. It's well below the market. People are buying because they believe the S&P is going lower as far as the volume. These are institutional traders here. Okay, we own a few ourselves. That is that contract. Once again, for the 119 contract that expires this Friday, I would just like to point out the $1,400 put had 149,000 traded. That's 70 handles below the current closing price of $14.70. They're 20 cents now. These people have been taken to the woodshed during when we had this is at the end of the year. This is your fiscal cliff resolution. We're right up here at the highs, but let's go to a contract that's much more important. That's going to be the February contract. And what I'm going to show here on the put side of this contract is this. Let's take a look in February of where some of the bigger open volume interests. That means people that have bought. 1380 has 3,900 contracts open. This is for February. The volume on the put side of the S&P for February on the open interest column, when we start looking at 1470, 1475, these are very good contracts. And why do I say that? Here's why. Here's why. When I show you a put chart for February, these puts are at the lowest level. Right now, they are, as far as a February contract goes. And there wasn't a lot of trades done for the February, but you can see here that they were up here at the highs and they finally have come down. And when the S&P 500 falls below 1470, then these go up in value. That's called a deflated put. When we take a look at some of the other open interest, like on the weekly, let's take a look at a weekly one, which is a weekly one, January 25th. This is a weekly contract. When they were up here at $70, now they're down here at $11. This is where the cheapest side of the market is. Any correction in the S&P 500, these will go higher. As far as a weekly, January 25th weekly expiration, 1470 put. The put side is going to expire for the January monthly contract. They're open interest here. These are tradable intraday. They've never been this. They were up here at $80. They gapped them down on the people starting the January 2013, and they've continued to take them all the way down here to these lows, which is right now at this particular level, and you got to know how to do this to make a market. We trade them right up to the close of a monthly expiration. However, with the S&P 500 being at 1470 close, today only down $1.37, we're in a major catalyst for 2013 earnings. This is the cheapest side of the market. That means that the S&P 500 has a major wall of resistance. And here is that wall of resistance up here. It hasn't broke through it. It is overbought at 94.70%. You are going to come down. Every time that we pop up, it's going to be harder and harder and harder for it to get through those resistance levels. There are great trades to trade on the S&P 500 using the put options. Another thing that I will throw in here is the volatility index, the VIX. Once again, what is the VIX? It's a fear indicator that's related to the S&P 500. We are at such complacently levels. We were up here at 22, 23 when markets were going through their turmoil. When the VIX goes higher, equities lose their value and they go down. When we're this complacent and we're consolidating the bottom here, the fear indicator, and at the same time, we have the wall of resistance here on the S&P at 1470. What will end up happening throughout the earnings volatility is we are very complacent. Any headlines or any big earning misses, this S&P 500 will have a contraction. And it's got the 10-day rising. Here's the 20-day at 1440. Here is where it started on the year, right here on 1-2. They gapped it up. Once they ran it here, we've gotten higher up in the S&P, but I can tell you that starting off a January slower earnings environment in the fundamentals, it's not the place to want to be long up here, the S&P right now, because of that resistance level with its narrow range days. Once again, I will conclude making a market with calls and puts. When it's doing good, you want to be on the call side. When it's going to get ready to drop, and the fear indicators at all-time lows, you want to be looking at the put side. It's the cheapest side of the market to make money when that reversal will come.